high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the major developments in the banking sector. It is 6th of July, 2023. I am Ruchika Chitravanshi. Here's what we have in store for you today. In our cover story, we get a read into the Financial Stability Report of the RBI. For our Banker's View this week, we have Shankar Chakravarti, Chairman of ESGrisk.ai, the country's only ESG rating agency. How will changes in TCS regime affect international credit card users? That's what we will discuss in the Banking for You segment. In our expert take, Tamal Bandhopadhyay will join us to give the lowdown on the recent HDFC merger, among other things. At the end of the show, we will share the results of the last week's poll and the question for this week's poll. The Reserve Bank of India's FSR, or the Financial Stability Report, gives us a picture of the risk to financial stability and the resilience of the Indian financial system. Now, this report points to the downward trend of NPAs in the scheduled commercial banks, but there are pockets of concern. In our cover story today, Manojit Saha explores, is the Indian banking sector in the pink of health?
Indian banks, which bear the brunt of bad loans in the last decade, seem to have crossed the hump. The latest Financial Stability Report from the Reserve Bank of India indicates. According to the report, gross non-performing assets, or GNPAs, as a percentage of advances, have declined from 11.8% in March 2018 to 3.9% in March 2023. This is the lowest in a decade. The net NPA ratio has fallen below 1%, the lowest since 2010-11. At the same time, the loan loss coverage ratio, an indicator of banks' balance sheet strength, is 74%. Both the capital adequacy ratio and the common equity tier 1 ratio of scheduled commercial banks rose to historical highs of 17.1% and 13.9% in March 2023. Clearly, what was known as the twin balance sheet challenge in the last decade has now turned out to be the twin balance sheet advantage, as RBI Governor Shaktikanta Das puts it. Improving asset quality has helped banks focus on loan growth, which according to RBI data is growing at 15.5% yearly. More importantly, retained loans have grown faster than the overall loan growth between March 2021 and March 2023. Retail loans grew at a compounded annual growth rate of 24.8% between March 2021 and March 2023. This is nearly double the CAGR of 13.8% for gross advances during the same period. Retail loans formed around one-third of the total banking system's gross advances.
The banking system has gone through its fair share of cycles, but we do believe that today the balance sheets are far stronger than they've been for the past few years. And this is clearly borne out by the trends that we're seeing in multiple parameters. Firstly, from an asset quality perspective, gross NPAs for the banking system have already hit a decadal low of about 3.9% as on March 23. And when we look at leading indicators such as the quality of the corporate loan portfolio and the CRISIL ratings credit ratio, that is the ratio of upgrades to downgrades, we're expecting a further reduction in gross NPAs this fiscal as well. Secondly, profitability. This was another decadal best for banks with ROAs touching 1.1% in fiscal 23, supported to a large extent by an expansion in the net interest margins. We do believe that NIMs have now peaked. Thirdly, what we've also seen is that capital buffers have also been significantly strengthened for banks. While private sector banks continue to be strongly capitalized with solid cushions over regulatory requirements, public sector banks have also demonstrated strong improvements in capitalization. So if I go back about 5 years, only a quarter of the public sector banks had a cushion of at least 100 bips over the regulatory tier 1 capital requirement. Today, all public sector banks have this 100 bips cushion. So banks are clearly on a stronger footing now compared with the past few years, and this is allowing them to focus on core business areas and growth.
Another area that the FSR flagged is unsecured loans. The share of unsecured retail loans increased from 22.9% to 25.2%, and secured loans declined from 77.1% to 74.8%. Yes, it is true that there has been a sharp improvement in credit culture, and banks also analyze credit bureau data for giving such loans. Yet, credit card NPAs of public sector banks, which have a much lower share in that market, are at 20%.
Specifically on retail loans, we've seen the portfolio at banks double over the past 5 years, and the share of retail in the overall loan book increased about 30% from around 23%. But just a few points to really put this in perspective. Firstly, though the share of home loans has come down, it still remains the largest segment within retail at just under 50%. And here we've seen that banks typically cater to salaried customers with relatively better credit profiles. Secondly, while the share of unsecured book in retail loans has increased to over 25% from just under 23%, a large part of this portfolio is really originated through cross-sell and therefore is expected to be already credit tested with the bank. Of course, all this is not to say that asset quality does not need to be monitored closely. In lending, any fast-growing portfolio needs close attention to credit appraisal and risk management systems to avoid rise in slippages to NPAs. Also, what you're seeing is as the retail book grows, there are some other structural shifts that we're seeing. As an example, the share of rural and semi-urban markets in unsecured personal loans has been going up. And what impact this may have on portfolio behavior will really need to be seen. So overall, we would say that while the current trends in the asset quality of retail loans of banks do not flag off any significant causes of concern, as the proportion of retail, especially the unsecured segment, increases, it will become more and more important to track early warning indicators and shift portfolio strategies or take any corrective steps very quickly if needed.
So Narayanan says the early warning signals need to be monitored closely. In this context, RBI Governor Shaktikanta Das also had a word of caution. He said, it has to be remembered that seeds of vulnerability often get sown during good times when risks tend to get overlooked. While the Financial Stability Report paints a good picture, banks cannot afford to drop their guard.
Sustained growth in bank credit, low levels of non-performing assets, and adequate capital and liquidity buffers are some of the factors that have kept the Indian financial sector stable, but we must heed the warning signals that Manojit's report has also highlighted. In our next segment, Raghu Mohan catches up with Shankar Chakravarti, chairman of ESGrisk.ai. As the head of India's only ESG rating agency, Chakravarti had loads to share on the current and future trends. Here's the chat.
Shankar Chakravarti, good to have on the BS Banking Show. See, the Reserve Bank survey on climate change and sustainable finance of July 2002 made a case that most banks are not ESG ready or they don't have a policy in place. Why do you think this is the case?
The concept of ESG is relatively new compared to the conventional risk management frameworks that banks has been using, which is fairly well established and old. And the concept of ESG is actually new. So while it is true that a lot of banks are still grappling with the ideas, but we also have to understand that we don't have enough data to establish the impact of ESG factors on the credit at the bank. So even if a bank, so ultimately, what are we looking at? The banks has to establish the impact of ESG factors on the debt repayment ability of the borrowers, right? So this is one factor which is very, very important for them to adopt ESG and use ESG factors to identify better quality credit and channel their resources towards better quality credit based on ESG factors. Now, to do that, one needs to have at least 2 economic cycles data, whereby you can establish the correlation between the impact, the factors and the impact of those factors. So this is what most of the banks are working on. we can say that I also agree with the point that yes, a lot of banks are not ready, but at least two or three banks I am working with very closely. I have seen that they are making very quick progress on that. I cannot say that, unfortunately, for all the banks, because it's a lot of banks are lagging behind in terms of their understanding of the issues. Second aspect of ESG is identifying areas where, so one part is being able to predict major credit failures using the E, S, and G principles. The other aspect of banking is to uh, understand for their existing exposure, they need to understand where the exposure lies. So for that, they need to build very detailed taxonomy, which currently was missing in India. Till at least 3 years back, I can tell you that there was efforts sporadically which was made here and there. But when we started building the ESG rating company, we realized that the taxonomies are not available, and we had to actually do all the work by ourselves and building the models, but the tools, the indicators, and the entire taxonomy ground up from scratch, which was not the case for when we look at US based companies. That is not the case, because you get a lot of work at the end of FSSB or GRI or even UNPRI. A lot of work has happened. So essentially, India lagged behind till, I can tell you that, little about a couple of years back, India literally did not have anything. In our case also, what we have done is we have taken heavily from GRI and UNPRI and FSSB to build our taxonomy. And I can tell you that now we have the taxonomy. A couple of banks are using our taxonomy also. But you are right that there is a lot of gap between where the regulators expect the banks to be and where they are currently.
In green finance, which agency is to evaluate and certify it is indeed so, and end use of funds is to be monitored?
Right. So you know that rating agencies are actually asked by the market regulators to monitor use of end use of funds. So this is already regulated. If you look at I can send you the recent guidelines to that effect. It has come about 1.5 years back. SEBI came up with this directive, where whenever a public issue happens, a company also has to appoint a monitoring agency for carrying out this activity. And rating agencies are the eligible, all rating agencies are given the permission to do that work. So there is a framework in place, but we have to, we are yet to see how well it is working. Because this is a new initiative, at this point of time, I'll not be able to tell you that rating agencies have caught misuse of funds or misdirection of funds as yet. But you can expect that in next couple of years' time, this is something that is likely to happen.
Now, lastly, at the societal level, what will it take to get a societal buy-in into this?
We have to show and we have to prove that ESG is ultimately practical, sensical thing to do. Indian society is inherently efficient. However, with more and more Western influence, things are changing. And while on one end we can see that our kids are extremely aware about the global climate change and all these kind of phenomena, but on the other hand, the ability of ourselves to recycle is going down. Our parents would use a Nokia phone, they will repair it 3 times 4 times in their lifetime and will use it for 10 years. But our kids will probably not have any way of repairing an iPhone and reusing it or any such phone. So So I think at a societal level, the change can only come when people actually see the benefit from practicing ESG. If practicing ESG is going to make your life more uncomfortable, more miserable, and more expensive, I don't think people will absorb it. So we have to create these kind of incentives for making, I gave you the example of water. It is very easy for the government to make water more expensive when they are not used in a efficient manner. And if those disincentives are created, and conversely incentives are created for practicing ESG, I think society will ultimately accept it.
Shankar Chakraborty, thanks for being on the BS Banking Show. We look forward to having you again. Have a good day.
Thank you.
Thank you.
So Shankar Chakraborty says there is not enough data to assess the impact of ESG indicators on credit at the bank. Well, understandable given it is still a fairly new concept. We have seen some back and forth by the government on the tax collected at source, or the TCS, on international spending through credit cards. What are the changes and how do they impact the users? Raghav Agarwal explains this in the next report.
Backtracking from its earlier announcement, the Centre on June 28 decided to defer the decision to include international credit card spending under the liberalized remittance scheme. According to the announcement by the Finance Ministry, there will be no change in the rate of tax collected at source on international spending through credit cards. This means the holders of international credit cards will not have to shell out additional charges while making transactions during their foreign trips. In May, the centre announced bringing the international credit card spending with a threshold of Rs 7 lakh under the LRS and attracting a higher rate of tax collected at source of 20%. This rule was to come into effect from July 1. Until June 30, the spending on international credit cards was excluded from the LRS through Rule 7 of the Foreign Exchange Management Rules 2000. Under the FEMA rules, all resident individuals, including minors, are allowed to remit up to $250,000 or around Rs 2.06 crore abroad per year without prior approval of the RBI. The Finance Ministry had clarified that it was being done to bring parity in the card transactions. The debit card attracted TCS under LRS, but credit cards did not. As a result, some individuals spent more than the LRS limits using credit cards. In the Budget 2023, the Finance Minister announced that the outward remittances under the LRS would attract 20% TCS from July 1. This meant the international credit card spending would also attract a 20% TCS. Later in March, while moving the Finance Bill 2023 in Lok Sabha, Finance Minister Nirmala Sitharaman had said RBI has been asked to look into ways to bring credit card payments under the LRS. After the announcement of bringing credit cards under LRS, experts argued that this would add a compliance burden on banks and that 20% TCS was too high. If the move was targeted towards tracking transactions, a lower TCS of 1 to 2% would have been enough. On June 28, the Finance Ministry notified that no TCS would be applicable on foreign expenditure through international credit cards till further notification. According to experts, the main reason behind this is that financial institutes need more time to modify their information technology systems to apply the tax. So for now, the users of international credit cards on their foreign trips will not have to pay any tax on their spending. The June notification also said that TCS would apply to foreign spendings above Rs 7 lakh. This will come into effect on October 1 instead of July 1. Notably, Rs 7 lakh is a combined threshold for all the spendings including medical purposes and education. This implies there will be no TCS up to Rs 7 lakh remittance under LRS. Beyond this Rs 7 lakh threshold, TCS shall be levied at the rate of 0.5% if remittance for education is financed by an education loan, 5% for remittance for education or medical treatment, and 20% for others. The purchase of a foreign tour package will also be subject to the Rs 7 lakh limit, but it will be counted separately from the above transactions. On the purchase of overseas tour packages, a TCS of 5% will be applicable on payments up to Rs 7 lakh. Above the Rs 7 lakh threshold, 20% TCS would be levied from October 1. Currently, the purchase of foreign tour packages attract 5% TCS without a threshold.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So foreign trips for now would not mean any extra tax on your credit card spending, but also because financial institutes need more time to modify their information technology systems to collect the tax. And now let us circle back to where we started. The FSR is one of the issues I discussed with our in-house expert Tamal Bandhopadhyay in our chat this week. We also talked about the HDFC merger and its implications. Hello, Tamal, and welcome to the Business Standard Banking Show. Let us start by discussing what is being called the biggest merger in the history of India, the HDFC Bank. Can you put in context for us? What does it mean for HDFC, and overall, how big is this?
Well, it's really big. It's really big. Trust you me. I mean, not in terms of assets, because if you look at State Bank of India's merger with its consolidation and the consolidation of the entire State Bank of India group, or what we have seen engineered by the government in the public sector banking, now we have a lesser number of banks. So in terms of size, asset size, loan book, probably it's not the biggest one. But when it comes to the market capitalization, in terms of market value, this is the biggest ever merger in Indian banking. And this merger actually has catapulted HDFC Bank into a big league. It's now fourth. It will be, the combined entity will be probably the fourth largest valued in terms of market cap in the global banking order. So that's one part of it. Other part is this. Why is this merger and why it took so long? Actually, if you ask me, why not? It could have been done even earlier. Historically or traditionally, investors have been looking for it. And every time the standard response of HDFC is this: look, this merger doesn't make any sense because of the regulatory cost. Because as you know, we have the regulatory requirement like SLR in the form of bond buying, CRR, keeping money with Reserve Bank of India, on which a bank does not earn any interest, and the so-called priority sector lending, 40% of your loan have to go to the priority sector. So these are the issues HDFC was saying, look, this is not done. I mean, the cost is too high. And what was the arrangement early recently done? HDFC Bank were selling home loan on behalf of HDFC. And there's sort of kind of internal fee sharing arrangement. But on its books, there are not too much of home loan. So that was one, actually, you can say, the gap in the product range of HDFC. So everybody wanted this merger to happen. Otherwise, also structurally, if you see, HDFC is an HFC or NBFC, which was holding 21% stake in HDFC Bank. And HDFC Bank, in turn, holds 100% in another non-banking finance company. So this is a structurally very odd in Indian banking system. So it has to be, now this anomaly has been addressed.
We've talked about the HDFC merger, but can you put in context what are the kind of mergers we've seen in the financial sector? What do they mean for the financial sector specifically?
The primary premise behind most of the merger in Indian banking system is to save a bank. Because since economic liberalization, there is not a single bank has been allowed to fail. Now, let's talk about the latest merger that we have seen. I mean, before HDFC, is the PMC, which is not even which is a cooperative bank. You know, now even PMC was not allowed to fail. I mean, because there are a lot of public money was involved, and now we have got it. It's turned into Unity SFB, Small Finance Bank. So whenever there had been a problem, our regulator, Reserve Bank of India, actually plays the matchmaker from behind the scene. Like, say, before that happened, Lakshmi Vilas Bank. Lakshmi Vilas Bank was taken over by TBS. Now, the first case where a foreign bank was allowed to take over a new a local bank. Of course, DVS is not exactly foreign because DVS is one of the two locally incorporated foreign banks. So most of the merger, and let's talk about the early this century when this Global Trust Bank was falling, the OBC, Oriental Bank of Commerce, were persuaded by Reserve Bank of India to take it over. So all the merger, because Reserve Bank of India does not want depositors to lose money. Reserve Bank of India does not encourage any bank, does not allow any bank to fail. So this is the history of merger. And if you look at like HDFC and HDFC Bank kind of merger happened also, like ICICI, the parent, reverse merge with ICICI Bank, or IDBI, the parent, got reverse merge with IDBI Bank. But there the story was different. ICICI was suffering from sort of asset liability mismatch. I'm talking about ICICI, the financial institution, not the bank. I'm talking about the development financial institution, because the so-called cheap funds which the government used to give, the government stopped it post liberalization, and ICICI, the development financial institution, was finding it difficult to survive. So then it got merged with ICICI Bank.
We've discussed the whole issue of the health of the banks many times in this show. We've recently had the FSR report by RBI. What is your read of it?
This financial sector stability report, which comes in June and December, it's a 6-monthly health check by the Reserve Bank of India, health check of the financial system or the Indian banking system. Now, typically it's very conservative. If you see in the past, it had always said that NPAs will go up, etc., etc. But this time, if you look at the financial stability report, it's pretty gung-ho. Well, our net NPA of the system is 3.9%. Last time we had this kind of level is 2011. One paragraph I was going through somewhere tucked away within Reserve Bank of India FSR, it talks about the stress in the unsecured retail loan. It says about that people's inability to pay off. Typically, you and me, when we take loan, our installment comes in 30 days. If we don't pay within 30 days, then it becomes a sort of special mention account. From 30 days to 60 days, 60 days to 90 days, and beyond 90 days, it becomes an NPA. So people, I think 7.4% of the loans of the borrowers are not being able to pay within 30 days. That's what it says. So there's some incipient stress happening. And if you, that's about the number of borrowers, 7.4%, if I'm not mistaken. And I think if you talk about the loan size, about 10% of the unsecured retail loan, borrowers not being able to pay within the 30 days period. So that's a little worry, I say. There could be slippages. So I think we should not just, celebrate. Banks need to be careful.
Important word of caution there, that banks have to be watchful of the NPA situation and the whole issue that has been flagged by RBI about the unsecured loans. But thanks for putting in perspective the whole issue of the HDFC merger and the mergers in the financial sector as a whole as well. Thanks, Tamal, for joining us. We will see you next week. And that is our roundup of some big banking news with Tamal. Now time to announce our poll results. Here's what we asked you last week. Are public sector bank CEOs grossly underpaid compared to their private sector counterparts? 72% of our respondents said yes, they are, while 28% said no, they are not underpaid. According to the latest announcement by the Finance Ministry, the holders of international credit cards will not have to shell out additional charges while making transactions during their foreign trips. The Forex card, however, has not been exempted. Then why will people opt for these cards going forward? Here's our poll question for this week. Is it the end of the road for Forex card? Our poll is open today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.